Harsha Upadhyaya joins us, CIO with Kotak AMC. Harsha, good morning. Thank you for joining us. Harsha, it's been a good solid comeback by the bulls. A month ago, 45 days ago, we were discussing trade war, uptick in crude, poor valuation levels. But all those concerns have now taken a back seat. Suddenly, this market has become Teflon coated. Why is that? Where are all the concerns and where are all the naysayers?
Good morning, Nikunj. I don't think the macro headwinds or the challenges are out of the way. I think despite some of those challenges, I think given the kind of strong inflows from domestic retail investors and ETF flows, markets seem to have shrugged off some of those concerns. But what we need to keep in mind is this rally is being driven by only a handful of stocks, and all of them are top heavyweights in the index, and hence the index movement seems very strong. But when you look at the broader market, there seems to be a lot of pain still in the market.
Okay. So, Harsha, what's been your portfolio approach? Because the aggregate numbers are picking up, but there seems to be a large differentiation. And when I say large differentiation, you have corporate banks where numbers have been okay. You have names like L&T where numbers have been strong. Consumers' numbers have been very okay. So, how do you propose one should now start looking at market? Should one stay with defensives, which is a combination of consumer and IT, or is it time to start buying risk and cyclicals now?
Nikunj, we are of the view that we should still maintain somewhat a cautious approach to portfolio construction. We believe that a barbell strategy at this point of time would work, wherein you would have defensives such as IT, pharma, and a little bit of maybe even FMCG in your portfolio. And on the other side, you will have some of the risky assets, for example, corporate facing banks and others. I don't think it's time for going completely into some of those risky bets, because the valuations of the overall market are not so cheap. While optically some of these beaten down sectors and stocks may look very cheap, the fundamentals still have not given enough confidence, at least for us, to take a larger and core position in the portfolio.
Harsha, we've been talking about the currency fall as a tailwind for enforcers and the larger IT sector as well as pharma names. Is that a position which you have increased tactically? Because it seems like for a better part of the medium term to, let's say, 18, 19 months, long term, I would imagine, the currency might be on the weaker side.
We were always of the view that the currency tailwind exists only for a couple of months or quarters, because there is always the repricing that happens with client interactions going forward. And to that extent, I think whatever benefit you would see from a currency depreciation would sustain only for a short period. So that cannot be the only argument for getting into some of the exporters. Having said that, we have seen some improvement in terms of management commentary in case of IT, and also have seen their margins sustaining reasonably well. So to that extent, we do have some defensive positions in the IT sector, which we will continue to hold. As far as pharma is concerned, I think one needs to be more stock specific. There are industry-wide issues even today. For example, the lack of US FDA approval still haunts the segment. So to that extent, I don't think one can go simply overweight on pharma without those clarities. As far as we are concerned, it's better to be in a few of the stocks where we believe there has been some amount of correction, and also the fundamentals are not so bad.
So, Harsha, I mean, what's the kind of correlation that we draw here? Banks, IT, or other, like you just mentioned, IT and pharma, typical exporters would do well. And is it spelling bad news, this entire Turkey incident, for metals, for private banks? You're seeing an aggravated fall, irrespective of SBI's numbers, all the brokerage upgrades coming in, the stock is actually falling. And to some extent, even consumers are.
See, the issue with consumer segment is the fact that while volume growth has been very, very strong, if you look at most of the volume growth trends, they have been in double digits for the last few quarters. So that is continuing quite handsomely. But the issue has been about valuations, where most of the FMCG stocks today are trading at historically high level of valuations. So to that extent, one needs to be a little bit cautious. But again, as long as the earnings growth and the volume growth continues, I think some of these stocks will continue to perform in the market. As far as the emerging market currency crisis is concerned, I think we'll have to wait and see how it unfolds. Yes, in the last 2 or 3 trading sessions, some of the currencies like Turkish lira or South African rand, etc., have fallen in double digits. I think that's leading to some amount of sell-off in emerging market currencies. And as you know, our own currency has been at a very sensitive level of 69 until now, and today it has breached that level. So to that extent, there is some amount of scare that is coming because of trade tariff related impact on currency and what that would mean to our own currency in the next few weeks and months. So to that extent, I would say that this is one of the bigger concerns that we have to see at this point of time.
Foreign market level, do you think for the year we've now pretty much topped out? Nifty at 11,000 plus, Sensex nearing 30,000, 30,000 plus. Do you think now for next 4 or 5 months we should not expect anything significant, at least for benchmark indices?
Nikunj, it's very difficult to make those guesses at this point of time. As you know, I mean, in the last few months, while everyone expected that the valuations are on the higher side and markets seem to be consolidating at a particular level, we have seen at least Nifty performing quite well in July and also in the early part of August. So to that extent, I think when a market is driven by a handful of stocks and that liquidity continues to be strong, it's very difficult to make a guess in terms of where it will stop or how it will unfold. But fundamentally, I think our market continues to be overvalued as far as current valuations are concerned. And also the earnings season, while one can call it, it's been in line with expectations, it won't help any positive change in terms of estimates for FY19 at least. In fact, FY19 earnings, according to us, will get downgraded a little bit post first quarter earnings. So given all these issues, I don't see a fundamental reason for market to really move up sharply from these levels. But liquidity can move it either ways in the short term.
Okay, Harsha, great having you on the show. Thank you so much for taking the time out and speaking with us today. That's the view coming in from the house of Kotak AMC.